everyone. Welcome back to the course on International Financial Management. Over the past two lectures, we have built a thorough theoretical understanding of translation exposure, what it is, how it arises, the four translation methods, the integral versus non-integral distinction, and how the income statement is translated. In today's lecture, we will first apply this understanding to balance sheet translation through a numerical example. Once we are clear on that, we will move on to managing the translation exposure with a focus on the balance sheet hedge. Let us begin. We have been given this numerical problem. In this, there is a US subsidiary named as XYZ Incorporation of an Indian parent company. That is, the figures are in USD and we have to convert them into rupees. The balance sheet of XYZ Incorporation as on 31st March is given below in USD. So, we have been given share capital, retained earnings, long-term debts, accounts payable and short-term debts. All these things are given in dollars. Similarly, the asset side, fixed asset, inventory, accounts receivable, cash and prepaid expenses are also given in dollars. The total of the liabilities is $1,75,000 and that of assets is $1,75,000. Now, we have also been given the information regarding the rate. The historical rate is $1 is equal to 75 rupees and the current closing rate is $1 is equal to 85 rupees. Now, let us do this question. First of all, let us go through the rate identification table in which we will come to know that under which method we will use the historical rate or the current rate for a fixed asset or a current assets, fine. Similarly, for fixed liabilities and the current liabilities. So, here we know that the current rate is used for the current assets and the non-current rate is used for the fixed assets or non-current assets. So, let us find here what are the fixed assets here. We have fixed assets here, inventory which is the current asset, accounts receivable which is also a current asset, cash in bank which is a current asset, prepaid expenses are current assets. So, all these assets will be converted into current rate and the fixed assets will be converted into historical rate. Now, we have the liability sides. In the liability sides, the long-term liabilities will be converted into historical rates, while the short-term liabilities will be converted into the current rates. Share capital is always converted into historical rate, while retained earnings will be our balancing figure. Now, let us come to monetary and non-monetary. Now, monetary and non-monetary means that are we actually trying to pay or receive something? Now, we have to see with respect of the item under consideration. If we talk about fixed assets, we are not going to sell or we are not purchasing it right now, it is already there. So, it will be using the historical rate. Inventory, if it is in the cost, inventory is valued at cost, it is going to be the historical rate, and since this is an asset to us, it is going to be historical rate. While if we see the accounts receivable, cash and bank, or in all these things there is a transfer of money. It is a monetary asset, and since it is a monetary asset, we are going to convert all our monetary assets into the current rate. If we talk about the prepaid expenses, these were the prior expenses for which we have already paid and hence we do not have to pay in future. So, these are fictitious assets and there is no monetary transaction to be done and hence it is going to be taken in the historical rate. While the long term debt and accounts payable, the long term debt we are still paying the interest, we will be paying the principal. So, we will be doing some payment in future. So, it is going to be converted into the current rate, while the accounts payable will also be done in current rate because we will be paying it. Short term debt also we will be paying within a year in the current rate. Share capital, as we have already mentioned earlier, will always be converted into historical rate. Next comes the temporal method. Temporal method is very similar to monetary and non-monetary method. The distinction arises only in terms of inventory. Now, if we see, if the inventory is at cost, then we are going to convert it in the historical rate. But if the inventory is valued at the market price, it is going to be converted into current rate. So, we value inventory at cost or market price, whichever is lower. Whichever is lower. Now, since it has been given current rate, so there is a probability that the inventory was valued at the market price. So, the rest everything of the temporal method is same as non-monetary and monetary method. Now, let us talk about the all current method. It is a very easy method because in which all the things are converted into the current rate, whether it is a monetary item, non-monetary item, or a fixed assets or a short term assets. So, current assets or non-current. So, we convert every item irrespective of its nature into the current rate, while as already told, the share capital will always be converted into historical rate. Now, here we have the balance sheet translation of current and non-current. Now, let us translate the balance sheet on the method on the basis of the method of current and non-current. Now, we have to see that what are our current liabilities and what are our non-current liabilities. So, if we talk here, this is a non-current liability, right? That is the long-term liability. This is a current liability, and share capitals, as we know, will always be generated, will always be converted into historical rate. So, here the long non-current liability will always be at a historical rate, which is 75 rupees per dollar given to us, while accounts payable, it is a current liability and hence will be converted into the current rate, which is 85 rupees per dollar. Short term liability is short term debt is also a current liability. Share capital, as we already know, will be converted into historical rate of 75 rupees per dollar. Now, let us talk about fixed assets. Now, fixed assets is a non-current asset, fine, and hence it is going to be converted at the historical rate of 75 rupees per dollar. Inventory here is a current asset. Accounts payable also a current asset, cash and bank also current assets, and prepaid expenses also current assets. All these current assets will be converted into the current rate, right. So, the cash will also be converted into the current rate. This is the rate which is the current rate. Now, what we will do? We will multiply these and we will get some amount here. Similarly, we will multiply these rates with the value to get the amounts in rupees. Now, we have calculated it for you. Now, see, here is the rupee value, which is 45 lakhs here, if we convert 60,000 at a rate of 75 rupees. Similarly, we get the other values also by multiplying the USD value into rate, we get the rupee value. Here also we have got the same thing. Our fixed asset were $80,000. We multiply it with 75 rupees per dollar and we got the rupee value of 60 lakh. And similarly, we have done this with the other items. Now, the question is, how are we going to balance it? Now, if we add all these things, the value that we get here is 1 crore 45 lakh, right? This is 1 crore 45 lakhs, clear? Now, if we add these things, it comes out to be 1 crore 12 lakh 25,000. Now, as our balance sheet is the rule is that the left hand side of the balance sheet should be equal to right hand side. But in this case, the right hand side, that is the asset total, is greater than the total of the liabilities. Fine. So, total of asset is greater than the total of liabilities. So, somewhere we have to bring the balancing figure here. So, this is going to be our balancing figure. And what is going to be the balancing figure? The balancing figure will be the difference of the total of the assets and the total of the liabilities here. So, here we have formed the balancing figure. So, this balancing figure we will write 1 crore 45,000, which is the total of assets, minus 1 crore 12 lakh 25,000, which is the total of liabilities, giving us 32 lakhs 75,000. So, we will write here 32 lakhs 75,000 and the total will be 1 crore 45 lakhs. Now, similarly, we are going to convert the balance sheet into on the basis of monetary and non-monetary method. We have been given the liability side and the asset sides. We will see which item is monetary and which item is non-monetary. Monetary items are those items in which there is some payment or receipt of the money in near future or immediately. Now, here if we see 60,000 is the long term debt. So, is it a monetary or non-monetary? First of all, it is monetary because we are paying interest and we will be paying the principal back. So, here there is going to be some monetary transactions. So, here the rate in the monetary asset is always the current rate. So, here we will have the current rate. Accounts payable, again monetary, we are doing transactions in it. Short term debt, again monetary, so hence converted into the current rate. Share capital, as already told, will always be at the historical rate, which is 75 rupees per dollar. Now, let us come to the fixed assets. Fixed assets, we are not doing any transactions in the fixed assets in the immediate or coming future. So, it is a non-monetary item, non-monetary item, and non-monetary item will always be converted into the historical rate of 75 rupees per dollar. And inventory will also be converted into historical rate of 75 rupees per dollar. It is in the physical form, that is why. Now, if we talk about accounts receivable, cash in bank, these are monetary items. So, this is also monetary, this is also monetary, will be converted into the current rate per dollar. Now, if we talk about the prepaid expenses, these expenses have already been done, nothing is going to be transacted now in future. So, hence this will be on the basis of the historical rate, and since it is a non-monetary item, so we will write here H is equal to 75 rupees per dollar, this is the historical rate. Now, we have to convert everything into rupee. We will multiply 60,000 USD into the rate given, which is 85 rupees per dollar, and we will multiply 25,000 into 85 rupees per dollar, and we will get the rupee value here. Similarly, we will multiply 80,000 into 75 and 40,000 into 75, and after multiplying all these values, we will get the rupee amount here. Now, see, here we have got the rupee amount. If we multiply 60,000 by 85, we get 51 lakhs, which is the long term debt, 85 into 25,000, we get 21 lakh 25,000. Similarly, we have done it for short term debt and the share capital at the historical rate. Now, we will talk about the fixed assets. We multiplied 80,000 by 75, we got 60 lakh. 40,000 by 75, we got 30 lakh, and so on. After multiplying all the balance sheet items with the respective rate, we get these figures in rupee terms, and we will now calculate the total of it. The total of it is coming 1 crore 40 lakh 50,000, and the total of this is 1 crore 18 lakh 25,000, which means that the left hand side, that is the total of liabilities, is less than the right hand side, which is the total of assets. So, somewhere what we have to do, we have to balance it, and the difference, that is total of the assets minus total of the liabilities, have to be written against the retained earnings, so that the whole balance sheet balances itself. And hence what we are going to do, this figure, the difference of this figure and this figure, will be the value of our retained earnings, irrespective of whatever is written in the USD. So, what we will do, we will subtract 1 crore 18 lakh 25,000 from 1 crore 40 lakh 50,000, and we get 22 lakh 25,000. So, we will write 22 lakh 25,000 here against the retained earnings, and we will make the total as 1 crore 40 lakh 50,000. Now, this is our retained earnings. There is no rate given here, and we are not actually converting the retained earnings either by historical rate or by the current rate. We are deriving this figure. So, you can see retained earnings are derived from the whole translation. So, we have now solved the balance sheet translation under the current non-current method and the monetary non-monetary method. I encourage you to try solving the same problem using the temporal method and the current rate method as well. The approach remains exactly the same, the structure does not change. The only difference lies in which items get translated at which rate. In the temporal method, the only key distinction from the monetary and non-monetary method lies in its valuation of inventory. Since the inventory is valued at market price, the current rate will be used for translation. In the current method, it is actually the simplest. All assets and liabilities are translated at the current closing rate, and equity items used at the historical rate, with the translation difference going to the FCTR, the foreign currency translation reserve. Now, on this slide, you can see the retained earning figures for all the four methods placed together. As you know, the balance sheet translation, retained earnings is always treated as the balancing figure. It's what makes the balance sheet tally after translating all other items. So, once you have attempted solving the balance sheet under any method, you can cross check and verify your answer directly from this table. The retained earning figures across all four methods is absorbing the translation difference in each case. This is where the gain or loss from the translation lands or is visible. And as we have established previously, for integral operations, this difference flows through the P&L, while for the non-integral operations under the all current method, it goes to the foreign currency translation reserve in equity. So far, we have been focused on understanding and measuring translation exposure. We know how it arises, we know how different methods handle different items, and we also know how both the balance sheet and income statements are affected. But understanding the exposure is only the first step. The equally important question is, What can a firm actually do about it? And this is where we need to make one important acknowledgement, and that is translation exposure cannot be entirely eliminated. As long as a multinational company consolidates foreign subsidiaries' financial statements, some translation differences will always arise. Exchange rates move, and they will inevitably create differences between how assets and liabilities are recorded and how they translate today. But the size of the exposed position can be managed. A firm can take deliberate steps to restructure its asset liability composition in foreign currencies so that the net position on which a translation gain or loss is calculated is minimized or ideally reduced to zero. The primary tool for doing this is known as balance sheet hedge, and this what we turn to now. A balance sheet hedge is defined as a strategy by which a firm deliberately adjusts the composition of its assets and liabilities in foreign currency so that the net exposed position and therefore the potential translation gain or loss is minimized or eliminated. Let us understand it carefully. The first keyword is deliberately. This is not something that happens accidentally. The firm is making a conscious strategic decision to restructure its financial position in foreign currency. The second key phrase is composition of assets and liabilities. The hedge does not involve entering into separate financial contract the way a forward contract or an option would. It involves changing what the firm holds and what it owes in the foreign currency. And the goal is to reduce the net exposed position, that is, the gap between exposed assets and exposed liabilities. Because translation gain or loss does not arise on the total assets or total liabilities in isolation. It arises on the net, that is, on the difference between the two. That is very simple. We have liabilities here, we have our assets here. We have fixed assets, current assets. Now we have fixed liabilities. Now in this fixed liabilities we have share capital and we have reserve. We have also current liabilities. Now if the total of liabilities is equal to total of assets, then there is no translation gain or loss. But when total of liabilities becomes greater than total of assets, then there is a translation loss. And this needs to be managed because in order to equate total liabilities is equal to total assets, we will have to reduce the reserve, and hence there is going to be some loss when we reduce the reserve. Before we can manage the exposed position, we need to be precise about what actually constitutes the exposed position. And this brings us back to a question we touched in the previous lecture. Which items are exposed? The answer depends on which translation method is being used. For items translated at a current or a closing rate, the value in home currency terms changes every time the exchange rate changes. These are the exposed items. For items translated at historical rate, their home currency value does not change when the exchange rate changes today. These are not exposed items. So, under the temporal or monetary, non monetary method, monetary items, that is, cash, receivables, payables, debt, are translated at a current rate and therefore they are exposed items. While non-monetary items like fixed assets, inventory or goodwill are translated at a historical rate and therefore they are not exposed. Under the current rate, all current methods, all assets and all liabilities are translated at the current closing rate. Everything is exposed except equity items which retain the historical rate. Under the temporal method, what matters for the hedge is the net monetary position, that is, monetary assets minus the monetary liabilities. Because only monetary items are exposed, the translation gain or loss is calculated on that net. Under the current method, everything on the balance sheet is exposed except equity. So, the exposed position is the total asset minus total liabilities, which is simply equity. This distinction has a direct practical implication. The balance sheet hedge strategy must be calibrated to translation method being used. What are you trying to equalize? Monetary items or total assets liabilities depend on which method applies. And as we established in the previous lecture, that depends upon whether the subsidiary is integral or non-integral. Now let us look at the balance sheet hedge in action, starting with what is arguably the most common concern, a subsidiary operating in a soft currency country. Soft currency country means the host country's currency is depreciating. A soft currency is one that is expected to depreciate against the parent's home currency. If the subsidiary is in country where the local currency is weakening, the parent's concern is simple. The assets held in that currency will translate to fewer home currency units over time. The subsidiary contributions to the consolidated net worth will shrink. In this scenario, the balance sheet hedge strategy is decrease soft currency assets because a smaller asset base in depreciating currency means less to lose when conversion happens. Increase soft currency liabilities because liabilities denominated in depreciating currency actually become cheaper to pay in home currency terms as the currency weakens. So, owing more in a soft currency is advantageous. In practical terms, this means reduce the subsidiary cash holdings in local currency, speed up the collection of receivables so that they can be converted quickly, increasing borrowing in local currency since that debt will be cheaper to pay later, and delay the payment of payables to the local creditors since those payables too will be cheaper to settle as the currency depreciates. The mirror image applies when the subsidiary is in the hard currency country, the country whose currency is expected to appreciate against the parent's home currency. Here, the parent's perspective is opposite. Assets held in the appreciating currency will translate to more home currency units over time. The subsidiary becomes more valuable in consolidated statements. The concern is not shrinkage. The concern is the liabilities in the appreciating currency becoming more expensive to repay. The underlying logic of the entire framework can be stated as two guiding principles, one for each currency environment. In a soft currency environment, you want to hold as little of the currency as possible on the asset side while owing as much as possible on the liability side. The reason is that the liabilities you owe in a depreciating currency becomes cheaper to repay over time, so you are deliberately creating a situation where your losses on the asset sides are offset or more than offset by your gains on the liability side. In hard currency environment, you want to hold as much of the currency as possible on the asset side while owing as little as possible on the liability side. The two principles are conceptually heart of the balance sheet hedge. Everything else in the strategy follows them. Alright, let us move to the understanding balance sheet hedge better with the help of illustration. We have two scenarios, one involving a soft currency and another involving a hard currency. Let us take one by one. Now we have a monetary asset of 5 lakh and this is Mexico, which is a soft currency, and we have monetary liability of 2 lakhs. So, what is our net exposed position is 3 lakh. So, here if the current rate is 4.80 and the expected rate after depreciation is 4.20, then in this scenario we have two parts to solve. First, what is the translation loss if we do nothing, and second, how do we hedge it. So, if we do nothing, what is going to be the translation loss? So, this is our net exposed position. We will multiply it with the rate, that is the current expected rate we have, and this will be 12,60,000, while the current rate was 14,40,000. So, what is going to be the translation loss? This is going to be the difference between the current rate and the expected rate, and this is 1,80,000. So, the subsidiary is asset heavy in depreciating currency. So, more assets in currency, in that particular currency, the more we are going to lose the value of the assets. So, hence the translated assets shrink. So, what is going to be the strategy? The strategy is going to be that since peso is a depreciating currency, which is here, we are going to use a soft currency strategy, and we will increase the peso liabilities to match the peso assets. We will take a loan of Mexican peso 3 lakh in local peso currency. So, when we are going to take this, then our monetary liability will increase to 5 lakh, and hence the net exposed position is going to be 0. Now, let us talk about a hard currency subsidiary, which is USA. The monetary asset is 2 lakh and the monetary liabilities is 5 lakh, and the next exposed position is in the liability sector, that is 3 lakh. We are having a higher liability, heavy liability. Now, suppose the rate was 83, which is the current rate, and the expected rate is 88. Now, if we convert it, then at the current rate we have this 2 crore 49 lakh rupees, and at the expected rate we have 2 crore 64 lakh. That means our liability are increasing, and when our liability are increasing, there is a loss of 15 lakh. Now, what should we do here? The subsidiary is liability heavy and it is in the appreciating currency. So, more liabilities in a currency that is gaining value leads to translated liability loss. Fine. So, what we have to do? We have to convert it into soft currency liability. So, we might take the loan in a soft currency. Fine. So, we can replace hard currency loan by a soft currency loan. So, let us bring both scenarios and both strategies together in the final comparison. Replacing the USD loan, the approach is to reduce USD liabilities and the result is lower exposure. Or we can also increase USD assets. This approach is to add USD inflows and the result is natural hedge. And that brings us to the end of today's lecture. Over the past 3 lectures on translation exposure, we have gone from understanding why it arises through the theory of how it is measured and managed today. Where we have applied all of that theory is actual numbers. In the next lecture, we will be exploring another dimension of foreign risk, that is country risk. I look forward to seeing you there. Thank you.